Ladies and gentlemen, good day and welcome to the Q3 FY23 earnings conference call of Kfin Technologies hosted by Kotak Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Sakhare from Kotak Securities Limited. Thank you and over to you, Mr. Sakhare.
Thank you, Michelle. Good evening, everyone. Welcome to earnings conference call of Kfin Technologies Limited to discuss the 3Q FY23 performance of the company and share industry and business updates. We have the senior management with us, represented by Mr. Srikanth Nadella, MD and CEO, Mr. Vivek Mathur, CFO, and Mr. Amit Murarka, Head Investor Relations. I would now like to hand over the call to Srikanth for his opening comments, after which we will take your questions. Over to you, Srikanth.
Thank you, Abhijit. Very good afternoon to one and all. This is Srikanth. I lead up to the organization as the Chief Executive, and thank you so much for giving your precious time this evening. Over the next half an hour, we would walk you through in terms of our performance for the quarter as well as for the 9 months ending 31st December, and would leave the floor open for questions for the later half of the call. So I'm going to start with, given this is our very first earnings call, I would like to take this opportunity to walk everyone and all through a little bit about our journey so far. Some of you might have heard about it, but we believe it's important to set some context. As an organization, Kfin Tech has been in existence since 1985, so long years in making. Started our business with rendering issuer solutions, which is effectively what you call as share transfer registry in today's world. Slightly late entrance into the mutual fund, started in 1995, and ever since, managed to, claw back some amount of lost time by winning, quite a significant number of mandates. Sometime around 2010, as the asset classes started expanding beyond the traditional asset classes of equity, debt, and into mutual funds, the alternatives have started to expand, and Kfin Tech as an organization, which is largely a technology and a platform-driven solutions provider, has expanded its solutions into all other asset classes as well, starting 2010. We also took extreme pride in starting probably the first international foray for an organization of this style based in India by starting our business in Southeast Asia, domiciled in Kuala Lumpur in Malaysia, and thus started our international expansion, especially from Southeast Asia standpoint. Around 2017, we have secured the license to become the second central record-keeping agent for national pension system. Over a period of time, we have expanded our footprint to a respectable 7% of the total market share over the last 4 years. And I will explain more in terms of what has been the specific and the growth associated with that in time to come. 2018 marked a very important year for us in terms of General Atlantic's a controlling stake buyout, which spawned 3 definitive transformational items. One of that was a technology transformation. Second was creation of an independent board and a fit-for-purpose management. And the third being largely acquisitive by nature, by outlook, which has resulted in Kfin Tech buying out the Sundaram BNP Paribas RTA business back in 2020. Last year, we have acquired Hexagram, which is a fund accounting administration platform, which gives us the very unique ability to be one of the only RTAs in the country who can handle both the asset side as well as the liability side of the book of a fund manager. 2021 also was an important year for us, with Kotak Mahindra Bank acquiring a sub 10% stake in us, and of course the December of 29 of the previous year, a momentous day for Kfin Tech when the company got successfully listed on the National Stock Exchange and the BSE. That's largely our journey so far. To sum it all up, investor solutions, broad business which covers the domestic mutual funds, international solutions in Southeast Asia and beyond, alternatives and the wealth management associated platforms and the national pension system. Issuer Solutions is a share transfer registry piece of work, and the Global Business Services, which is more an outsourcing sort of work that we do for specific clients in the mortgage space, and some amount of F&A outsourcing, as well as the general ledger accounting outsourcing for the Middle Eastern banks. Quickly moving on, just in terms of what is this organization at a very a high-level glance, we are the largest investor solution provider to the Indian mutual funds in the form of the number of asset management companies. 26 out of 46 asset management companies are Kfin Tech's clients. Of these, 41 are operational at this point in time. Of the 41, 24 are Kfin Tech's clients. We manage a total AUM of 12.7 trillion rupees. And one that is expanding fast year after year. Our win rate had been 15 out of 22 in the past X number of years, exemplifying the growth that is contributed not just by the client's growth, but as well as new clients getting added, and ergo driving the expansion of our overall AUM as well as equity AUM. Our overall market share for the equity is 35%. In terms of SIP monthly inflow, which is the bellwether and the sticky retail book, which tends to compound over a period of time, stands at 41.6% for the period ending December 2022. Overall number of folios, if you add up between investor solutions and issuer solutions, Kfin Tech has close to 225 million folios, which makes Kfin Tech amongst the largest registrars in this world. Issuer Solutions, we have a 49% market share when you count the market cap of the Nifty 500 companies that Kfin Tech services. Even by count, Kfin Tech has a little around 43% market share on the total number of corporates listed on the Nifty 500. Overall base is about 5,100 clients, and we add little around 150 odd corporates every single quarter, be it listed or unlisted together. Whilst investor solutions on domestic funds and issuer solutions have been our traditional businesses, Kfin Tech has had expansions into international and other investor solutions, which have been the faster growing businesses. Today we manage 33 international clientele between Southeast Asia and beyond. In the case of central record keeping agencies, we are one of the 3 CRAs, and we manage close to 0.9 million subscribers, which accounts for 7% of the total market share. On the alternate investment funds, we have about 348 AIFs secured, marks about a third of the total AIFs, which has a composition of full-scale model of TA plus FA plus value-added solutions. Some of these are purely for regulatory and compliance requirements on stamp duty, what have you. Overall, beyond the statistics, we have been an extremely innovative company at the core. Launched over 20 products. Many of these are monetized directly or indirectly, contributing to the growth of our clients. In terms of volumes of transaction, Kfin Tech manages as many transactions as the industry, nearly as much as the industry does at this point in time. And in terms of ESG rating, we are rated as the second best corporate in the country, rated A, and we pride in tracking to our internal security scores of our infrastructure, which stands at a very impressive 770 plus as of December. Our growth largely has been on the back of very simple, keep it simple, but then execute it well, effectively by maintaining a market leadership through excellent delivery, through relationship with our clients, and that we believe we can do only and only through very effective technology investments and process innovation. We continue to expand internationally, organically, as well as inorganically in the form of acquisitions. And none of this is truly possible without retaining strong talent. As you would see that Kfin Tech continues to invest in talent, both in terms of additional new count as well as in terms of retention of key personnel. We have also significantly enhanced our sales capability, our products and transformation innovation capability over the past 12 months. Broadly, in terms of our highlights for Q3 and the 9 months ending December, we continue to maintain our growth trajectory with a combination of growth on the traditional businesses as well as faster expansion of the younger businesses. Overall, Q3 revenues grew by 12% year on year. EBITDA grew by 9%. Margins for the Q3 stands at 42.9%. Our PAT has grown 79% year on year. and margins stand at 28.4%, the PAT margin at 28.4% for the Q3. For the ending 9 months, our revenue grew 17%. EBITDA growth was at 5 year-on-year, and margins stand at 39.9% for the cumulative period of 9 months, even as the PAT has grown by 42% and margin standing at 25.8%. As I said, our business is broadly composed of domestic mutual funds, which has a total share of close to about 68%, and the rest of the business on the issuer, international alternatives, etc., constitute the remaining 30% plus. Our mutual funds business, overall AUM continues to expand faster than the industry. For example, our AUM has expanded by 8.5% year-on-year, as against an industry growth of 5.4%. Our AUM market share, on the other hand, has expanded by a full 100 basis points from the previous year, which now stands at 31.7%. That's a substantial market share gain in 12-month period, even as the market has expanded. Our equity AUM market share is at 35%. Through this period, we have also won a new mandate of Old Bridge Capital, even as one of our erstwhile client, Navi, has chosen to partner with CAMS in terms of the new management intending to align on a broader corporate relationships. Issuer Solutions, which is one of our faster growing businesses, has grown over 40% year-on-year as well as quarter-on-quarter broadly. We have added 128 clients, making our total client base to 5,000 plus. Close to 0.8 million investor folios have been added, making it one of the largest registrar in the country. Even as a market share in terms of NSE 500 companies stands at 49% for Q3 versus what was 43% Q3 for FY22. Our international investor solutions, we have added 33 clients. We have totally 33 clients at this point in time, which stood at 22 for the previous 9 months ending December 2022. We have won our first client outside of India and Asia into Canada for providing full-scale fund administration services. For 2 funds of this client, we believe this would be a good segue for us to expand into the western part of the world, where fund accounting administration is a fairly large addressable market with a $6 billion plus ticket size. We started our operations in GIFT City in February, and we have already onboarded 6 funds in there, 4 being GIFT City domicile and 2 international funds. On the alternatives, one of the asset classes we are very, very excited about in terms of the growth prospects, as well as the value that we can offer to the asset managers and to the distribution network and to the investors. 47 funds have been added in Q3 alone, taking the total number of funds to 348 for the period ending December 2022. Our market share stands at 33% versus what was 30% in the previous year, and our AUM correspondingly has grown 28% year-on-year and 3% quarter-on-quarter. Our spectrum of services for alternatives also has grown beyond the traditional transfer agency work with the acquisition of Hexagram, where now we render end-to-end solutions of transfer agency, fund accounting administration, entire stack of digital onboarding, and all the other value-added solutions. National pension system, we continue to add sizable numbers with each passing day. Our market share stands at 7%, as I already called out. We look at expanding the not just the market share, but also creating the market itself quite substantially. We have launched a corporate-specific product called Future. We have been adding a little around 100 odd corporates every single quarter, even as we intend to transition from ENPS model into the corporate model through very, very specific and targeted solutions we believe will help the corporate employees to subscribe to national pension system through that particular platform. Overall, mutual funds itself, from an India performance standpoint, as one can easily read from the public domain, has been seeing sizable growth. This year, for the period ending 2023, 5% year-on-year, 3% quarter-on-quarter, little subdued compared to the past 3 years broadly. But as I've already explained, in comparison to 5.4% of industry growth, Kfin had grown over 8.4%, which effectively marks much higher net flows into Kfin service funds. Equity AUM stands at 35% for Kfin, even as the overall growth had been 12% year-on-year. Kfin market growth also had been similar, slightly higher than 12.4, standing at 12.8%. SIP inflows, I have already called that out. Kfin Tech's number, overall share of the wallet is about 42%, even though overall equity AUM stands at 35% and the overall AUM stands at 31%. The retail book, which is usually sticky and compounding, is something that we believe will over time help Kfin Tech's overall AUM share to increase beyond where it currently stands today. In terms of the number of folios and number of transactions, however, we have near parity in the industry in terms of the total number of transactions we process, as well as the total number of folios we manage, both in terms of overall AUM as well as on the equity side of things, which effectively speaks about, again, a lot of retail book, right? And in terms of the other asset classes, even as the overall AIFs registered continue to expand, our win rate, doesn't necessarily justify the revenue. It should be higher, as we believe many of the AIFs will go on to launch their funds into the coming months and quarter, which effectively should drive the revenue higher up from where we are today. Now, given we operate at every asset class in a decentralized manner, number of Demat account expansion is very important for us, as that impacts our revenue for issuer solutions, which has grown over 40%, as I have already called out. So increase in the number of clients as well as the much broader retail participation helps issuer solutions grow, even as technology-enabled products and platforms we created for the corporates at large has been helping us to drive our value-added solutions as well. International, mutual funds, specifically on the Southeast Asian side, we see the opportunity size, if you add up the geographies of Singapore, Hong Kong, Malaysia, Philippines, Indonesia, and Thailand to be around $1.3 trillion, which is a little over 2 times the size of India. And Kfin Tech renders both transfer agency and fund accounting administration services in this part of the world. A very young, nascent business, one that has been growing quite rapidly. Notwithstanding the fact that last year the Southeast Asian markets mark-to-market has come down by over 5%, but our win rates and a pretty significant pipeline hopefully will augur well in terms of the growth that is potentially possible into the coming quarters in this line of the business. Our own business highlights, overall AUM, as I said, has increased by a full 100 basis points compared to 9 months of the previous year, from 30.7 to 31.7. Overall equity AUM market share is stable at 35%. For the year, for the quarter ending, December, we stand at 31.7, 35 on equity, and overall mix of equity to our AUM stands at 56%, which has seen expansion by a little around 240 basis points for the previous year. In terms of the SIP, overall inflows, both in terms of the folios and in terms of the value, we stand close to 42%. Folios itself has been growing much faster than the value, which I'd like to believe over a period of time will catch up with the total value itself. In terms of our transaction volume, we have seen a significant rise in the overall volumes by a little over 15% in mutual funds, and if I aggregate all the businesses together, it is a 28% increase in volumes across our lines of businesses. This, if you read in the context of our overall operations and the productivity we drove, with a net headcount reduction during this period, and it's largely on account of the technological transformation we're able to bring to life. Partnering with our, with CAMS on the MF Central, we have launched the CAS API together as partners in this journey, and in times to come, all commercial and non-commercial transaction APIs will also be expanded and extended to all the digital and the fintech ecosystem in the country, which we believe will add a certain amount of revenue base for both the organizations. Issuer Solutions has moved, as I said, we've added about 12% year on year and about 2.5% quarter on quarter. Folio expansion has been a little over 13% in terms of the number of clients itself. On Nifty 500, from December 2021, where the market share was 35%, today it stands close to 40%. In terms of number of folios, too, has expanded from 37% to 43%. Market cap of the Nifty 500 has moved from 42.9 to 49%, speaking volumes about the quality of the clientele and the wins we've had through this period, even as the revenues have seen close to 40% growth during this period. We have seen an expansion of our international clientele from 22 to 33. This is largely on the back of our acquisition of Hexagram, which has added international clients, as well as organic growth of Kfin Tech's own all clients. Overall, AUM itself has seen a slight dip. That's largely in the context of the mark-to-market reduction in most of the operating geographies in that part of the world. But we believe that is sporadic and probably a one-time blip in the radar. That should correct itself in time to come, even as the transaction volumes during this period has increased fourfold from 0.9 million to 4 million between FY20 and December FY2023. In terms of other solutions, broadly alternatives, our revenues have grown AIF a little around 42%, and our AUM also has expanded in terms of the operating AUM has expanded around 28% year on year. Fund administration has moved from 23 to 32 during this period, from March to December 22, that is, which also has 8 international clients between Southeast Asia and Canada, so to speak. In terms of pensions, we have gone live with the state of Madhya Pradesh the previous year. We have nearly doubled our subscriber count from 0.35 to close to 0.9. 0.45 to 0.9, nearly doubled both the folio, both the subscriber count as well as our revenues during this period of the national pension system, even as we have added a sizable number of corporates and POPs during this period of time. That's broadly the business highlights. I would request Mr. Vivek Mathur to walk you through on the financials.
Thanks, Shrikant. On the financials, if you look at quarter ended FY23 and 9 months ended December 31st, the revenue has gone up by 17.1% year on year, and quarter on quarter it has gone up by 12.1%. In terms of last 9 months versus this period 9 months. And if you look at Q2 to Q3 within the same financial year, it has gone up by 5%. It's largely backed by the increase in domestic mutual fund business by about 5% quarter on quarter. Issuer solutions has gone up by 6% quarter on quarter. International and other investor solutions has gone up by about 11.5%. If you look at year on year, the domestic mutual fund has gone up by 11%, issuer solutions about 39%, international and other investor solutions by about 46%. This includes the integration with Hexagram and besides other businesses of AIF and pension and Southeast Asia business. So overall growth is 46% year on year. On the global business services, there is a growth of 7.7% for the year, while there is slight dip in the quarter on quarter of about 5%. That's more because of the FX gain that we have, that we see the year on year increase, while the number of seats that we have been operating with for the mortgage servicing business still remain the same. If you look at the EBITDA has gone up by about 5%, but if you see quarter on quarter, it has gone up by 13.6%. And on the year on year basis, if you see same period of 9 months and same period of 9 months last year, that growth of 5% is there. But if you see year on year, it is 9%. Same quarter last year versus same quarter this year. However, our EBITDA margin continued to be in the range of 40 to 45% as we maintained. It's 39.9% for 9 months ended December 22, and for the quarter it is 42.9%. So, typically Q1 and Q2 see the stress of increments and expenses coming in, and as the business grows and revenue grows in Q2 and Q3, it catches up, and that's how Q3 FY23 sees an EBITDA margin of 42.9%. PAT has touched 42% growth year on year. In terms of quarter on quarter, it is 11.4%, but as compared to last year, same period, same quarter, it's 78.6%. PAT margins have touched 25.8%, while for the quarter it is 28.4%, and we maintain healthy cash flows of about 229 crores, and therefore the EPS on a diluted basis has gone up by 29% from 3.15 for this quarter, and 9 months is 8.20. That's very high level summary of the financials. and we are happy to take questions now. Abhijit, over to you.
Thank you very much, sir. Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Aegis Lakhani from Unifi Capital. Please go ahead.
Yeah, hi. Congratulations on the numbers, and thanks for the maiden call, summary that you gave regarding the business. Shrikant, couple of questions. First is, if you could talk about Navi. I mean, I thought that was a recent mandate. So what made them go to the competition? That's one. And on telescopic pricing, what we understand is that prices, because of the telescopic nature, are already there's no scope for further reduction, but the regulator comes out and has made some statements. So your thoughts on pricing, is there any scope for pricing to still come down? And Vivek, one question to you is Hexagram. What was the revenue number this quarter, because it was not there last year this time? So could you call the number separately? Thanks.
Thank you, Aegis. No, Navi is not a new client. Navi took over SL. SL was Kfin's client back in the day, and with the change in the management of the organization, Kfin Tech manages the fund accounting administration side of the business for Navi. It is possibly due to segregation duty. Typically, if you see in Indian mutual fund industry, we don't do TA and FA together. It could be possibly for that reason. So it's not a new client. Second, in terms of the yield compression, it's telescopic pricing is what it is. To that extent, as the as the value overall corpus increases, clearly there is an expected certain amount of compression that is to be seen. In terms of the regulators' commentary, if you see I think the request or the council sought on the consultation paper, it was largely with a view to stop or at least to manage mis-selling, if I may, in terms of investors' money being moved from one fund to the another with a view to secure higher TER, if I may, right? And the very specific purpose, as stated, was that. And it has no bearing on the registrar's operations. Our operations and the costs and etc. continue to be disengaged with on the selling side of the fund, so to speak. So we believe that beyond the telescopic pricing, we may not see any additional yield compression.
Yeah, on the question, this is Vivek. On the question related to Hexagram revenue, it was 8.8 crores for the 9 months ended December 22.
Got it. Thanks. Shrikant, just to follow up on that, in renegotiations that you would have had with recent clients, has there been any pressure on yields when you've been having these conversations? And just on the international piece, you had mentioned earlier that you won some geographies. So when do those, some new clients in, different geographies. So when do those go live? I mean, should we expect something in the next quarter, or will it be in the year 24? Thanks.
Thank you, Aegis. I'll answer the second question first. So we have already gone live with our client in Canada. In the last meeting we've had earlier in the previous year, it was still under negotiation and early parts of transition. So we have successfully gone live, as of January for 2 funds for the client based in Canada. In addition to that, I think in the Southeast Asian side, of course, we continue to, look to expand our operations into Thailand, subject to necessary regulatory approval. So that is yet to happen. In terms of the contract renegotiations, our contracts are largely, now this question is very specific to domestic mutual funds. It doesn't happen with any other business. In fact, most of the businesses, the fee goes up. The contract negotiation itself is a factor of the contracting terms, which is anywhere between 3 to 5 years, depending upon which client you speak with. Depending upon any amount of significantly higher growth or maybe even lower growth for that matter, we take certain steps to partner with our client, so as to enable their growth faster. So short answer, can yield compression be possible at the time of contract renegotiation? The answer is yes, but by and large, it would be minimal in comparison to the telescopic pricing related impact.
Got it. Thanks a ton. I'll fall back in queue.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may please press star and 1 now. We have the next question from the line of Devansh N from Simple. Please go ahead.
Yeah, so thanks for the opportunity. Sir, in case of employee cost, can you share the headcount as on March 22 and March 21 and December 22?
Yeah, just give us a moment, please. So the dates you're looking, so March 2022, last year beginning we were at 5,440. And December, for the period ending, the previous month, we were at 5,300. And sorry, what was the other period that you asked for?
March 21.
March 21 was 4,900.
Okay. So over here, what is the annual appraisal cycle for us?
Typically, it is April, like any other Indian corporate, yes.
Okay, because if I exclude the employee costs, if I look at X ESOP, so there has been a significant increase. So can you help us understand where it's coming from?
Yeah, this is Vivek. In terms of the employee cost, the increase is largely related to a reset for the IT employees that we have. Then there is, integration of Hexagram that has an additional cost of all the employees, employee cost coming in, and the regular increments that we give. We have also seen increase in replacement cost during the year based on the demand supply situation that we experienced. So we have seen an average cost going up of upwards of 20% in terms of replacement cost. So and besides, this is all besides the ESOP cost, which is exceptionally different for this year being the IPO year and the vesting happening this year. So these are the main reasons for increase in employee cost.
Okay, but I mean, let's say if I look at if I look at standalone and if I exclude the ESOP cost, it was 52 crores in December 22 and December 21 was 36. With no change in employee cost, the cost increase ex ESOP is actually 50%. So 44%. Sorry.
Yes. So
44% if I break that up.
Yeah. Out of 44%, you can take about 9 to 10% increase in the average increment that was there for that was given in April, and then you look at the reset of employee costs for IT folks was across the industry almost doubled in some cases. In cases where you really need skilled employee, and as a company which is heavily into technology, we need to retain talent. And therefore, we had to increase the salaries for those employees. Although we have taken some corrective actions in terms of, resetting the engagement with external resources, the consultants that we used to hire. So we have cut down cost on that front while retaining the talented employees, and therefore the increase in cost. We believe this is not recurring in nature. This was one-time reset that was necessary given the market demand and supply situation in this area. And this is something which we will see is already easing out. Now we see in the last quarter the cost is actually stabilized. It is not going any further. And we do expect that, in the coming financial year, we will not see something like this happening.
But even if I look at QOQ, what we hear is that now there has been a lot of firing that has been happening, globally, and but if I look at our QOQ employee cost ex ESOP, even that has increased 20% QOQ. So I'm just a bit confused.
I'm sorry, QOQ, the employee cost has come down.
Ex ESOP, excluding ESOP cost. The ESOP cost is 16 crore for this quarter and 30 crores.
That's the impact of the increase that we have done vis-a-vis last year. If you see, last year there was no reset of IT cost. This year there is a reset of IT cost. So it will have that impact until the financial year ends. So you will continue to see this impact on quarter because of the one-time reset that was done. So, it is not that it will have only one quarter impact. It is a reset of the entire cost. Amit, you want to add anything?
Yeah, so I think you are referring, not really sure in terms of the numbers, right? I mean, on the employee cost, for the quarter, we had 72.5 crores, right, versus 76 crores in the last quarter. So that's a 5% decline. And if I reset the number, based on basically excluding the ESOP cost, then basically still my cost is down by 3% because my ESOP cost was 1.6 crores for the quarter and last quarter it was 3.1 crores. So excluding the ESOP cost also, the overall employee cost has been down on a quarter-on-quarter basis as well. So like what Shrikant and Vivek was mentioning that, there were a couple of reasons why on a YOY basis for the full nine months, why the cost has gone up. A couple of reasons in terms of, the reset in the IT salary, the addition of the Hexagram, team as part of the core team. And then, the investment that the company did in terms of setting up the whole, the sales organizations in terms of, basically beefing up my AIF and the fund administration team in India, and then also adding up people in terms of, for the Southeast Asian, business as well. So some of these elements have added up to the cost on a YOY basis, against which the matching revenue we are yet to see. We are already seeing a lot of traction in terms of, building up the pipeline for the international market as well as, the number of mandates that we have been able to add in, in the AIF business. So that is all because, the last 1.5 years, the way the team has been built and the organization that we have set up in some of the new and the younger businesses, that is something that is, adding up to the cost, but we'll see the corresponding revenue in the subsequent period, as we go along.
Got it. And in case of
Devansh, I'm sorry to interrupt, sir. I would request you to kindly rejoin the queue, please, as we have many other participants. Thank you, sir. The next question is from the line of Ajox Frederick from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, my question is on the international.
Sir, I'm sorry to interrupt. Sir, your audio is not clear. May we request you to use your handset to ask a question, please?
Yeah, sure. Is this better now?
Thank you, sir.
Yeah. Sir, my question is on the international solutions. I noticed that the AUM has come down, but still we were able to do very well on the year-on-year numbers. So what is the revenue model here? How are we pricing the client? Is it on AUM or transactions, or how do we do it?
Yeah, so please read that as international and other investor solutions. So that also includes revenue pool coming from AIF business as well and national pension system.
Oh, okay.
And the international business itself, yes, the AUM has come down because of mark-to-market reduction in most of the operating geographies there. Yet there has been an overall revenue increase, close to 45% in the overall international piece. Alternate investment funds have contributed to 42% plus growth. Wealth management pensions have grown, nearly about twice as fast in the previous quarter. The international mutual fund solutions itself, has had 5% growth, despite a mark-to-market reduction in the AUM.
Which means that the yields have gone up for that international MF-based solution?
That's correct.
Okay.
So broadly, our
AUM
asset
has
mix and the yield, our yield is roughly about 5 basis points in international operations, and overall asset quality has improved more towards equity. And also some of the clients who have been transitioned into later part of the year, now we have full year's revenue coming in.
Got it, sir. Got it. That's very helpful. Just one question on the ESOPs. So what's the pending ESOP outlay we have probably for the next quarter or for the next year?
The ESOP pool is almost 85% utilized. So
Okay.
balance pool is about 15%. And as and when the board decides to do anything new, it will come up. But as of now, it's 85% utilized.
Got it, sir. Thank you very much and all the best.
Thank you. Before we take the next question, a reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Sonal Minhas from Prescient Investment Management. Please go ahead.
Hi, sir. This is Sonal. Am I audible?
Yes, you are.
Yes, sir.
Hi. Thanks for taking my question. I had a question to understand your debtor cycle when compared to your leading competitor, which is CAMS. I just wanted to understand like the business practice at the nuts and bolts level to understand why there are such high debtors in this business compared to the only competitor we have. So we need to compare to them. And what are we doing to actually bring this down, or is this like a business kind of a call that we've taken? This is what we basically would go ahead with. And the second part, I think there is that there are also some write-offs we do take on a quarterly or yearly basis on these debtors. So I wanted to understand, since we are dealing with high quality mutual funds, asset managers, AMCs, and what is the need to actually write down those receivables at the end of the year?
Yeah, so thanks for your question. As you would know that about 68% of our business revenue comes from mutual fund. There is still 32% of the business which is non-domestic mutual fund. Yes. And about 14% of the business comes from issuer solutions, which is the listed and unlisted clients that we service for portfolio management and corporate actions. And that is where the the DSO cycle collection period is much higher. It's upwards of 90 days on an average, and that is what puts stress on the overall DSO. While there are 5,100 corporates that we service, everybody has got a different cycle in terms of So we do unbilled revenue accounting. Besides the billed revenue accounting to accrue for revenue, while the actual bill may get raised on a quarterly basis or half-yearly basis or yearly basis. And that's how the impact of actual collections versus outstanding is reflected there. As far as mutual funds are concerned, they are regular payers. There may be some delay. We actually, have a 40 days normal period, credit cycle period with the mutual funds. Usually they pay on time, and in some cases where there are some negotiations going on, not just on mutual fund but on large VAS product that comes into play in terms of trying to put pressure to hold back some payment, which results in some delay. But that's exceptional in nature. That's not a regular feature. So
is 40 days, even if we just assume 40 days for mutual funds, isn't that on the higher side? Because if we talk about financial intermediaries, and you are being one of them, and compared to, let's say, other companies, typically financial intermediaries or the nuts and bolts businesses in the entire chain, they don't have such high working capital days. And we're dealing with like high velocity kind of transactions or kind of financials with companies. So please help me understand why even 40 days. If you
so why I'm saying 40 days is, let's say 1st of December to the day the bill is raised is it takes about 35 days from the day one to the actual billing days. And then once the bill is raised, then the credit period is not more than 10 days. So I am taking 30 days of the period of the month itself to say, you are processing, you are working, you are processing the transactions, but the actual bill is raised after 30 days. then 10 days of credit period. So 5 days you take to raise the bill and another 5 days you give credit. That's how I'm looking at credit period. So it's not from the day the bill is raised we give 40 days.
Okay, got it. Understand that. And the second part was just to understand, is there a way in which the cycle should be reduced, or is there intention to reduce the cycle over time? Just trying to understand.
Yeah. So we are working with our team and the corporates to reduce the payout period from 90 days to 60 days and eventually coming down to 30 days. But it is a journey where clients who are specifically unbilled clients, where they pay, based on their convenience, or unless there is a corporate action, they don't bother to pay. We are now sending formal reminder notices. There are, regular follow-ups, engagement in terms of selling them value-added services. At the same time, we request for payment. So there is enhanced focus. This period used to be much higher in the past. We have now brought it down considerably, and we expect that between now to next year when we meet, there will be substantial improvement in the DSO.
Got it, sir. That's it from my side. Thank you. Thanks for explaining. Yeah.
Thank you. The next question is from the line of Abhijit Sakhare from Kotak Securities Limited. Please go ahead.
Yeah, hi. Thanks. Just a question on OPEX. We're coming out of a fairly, strong growth as far as OPEX is concerned, not just for you, but more generally at an industry level as well. But now that the revenue outlook is probably a little more muted or a lot more volatile given the AUM linkage, what is your visibility or let's say flexibility, to put it that way, to kind of manage OPEX more in a much more better way, so that the operating leverage or the margin trajectory remains within a fairly guided range?
Yeah, thanks Abhijit for your question. We are constantly working on cost optimization initiatives. We have given up 2 floors in Selenium head office. We are now at the end of December almost flat in terms of headcount as we were last year December. So whatever increase that we have seen during the year has been normalized by taking action in the last quarter of the calendar year, and this will flow into Q4 as well. And there are constant initiatives being explored to cut down on cost. Having said that, we stick to our overall guidance on 40 to 45% EBITDA margin. So whatever stress we have seen because of the AUM movement or because of any pressure coming because of reduced VAS revenue as compared to what we were expecting, and augmentation in terms of investment in technology that we have done, we constantly look at all the parameters to ensure that we maintain that range of 40 to 45% EBITDA margin. Having said that, Amit Murarka himself is leading many of these cost initiatives that I talked about. I have talked about 2 or 3. We are constantly looking at enhancing VAS revenue. There is a strong pipeline of VAS revenue that will emerge in terms of culmination of contracts and revenue in quarters to come. And therefore, we are not depending on purely on AUM based fee. There is a strong pipeline even in Southeast Asia. As we know, it takes time. So we are working both. What I want to say is we are working on both revenue as well as cost side, how we can add more value to our client by giving value added services, how we can win back clients in the issuer solutions, both from new IPOs as well as from existing clients of other RTAs through our value proposition. We are constantly looking at how do we optimize cost, both in terms of headcount and operating expenses. Like what I mentioned to you that, although the cost reset was done for IT employees, where the cost went up, but we have taken a parallel action in terms of reducing dependency on outsourced IT manpower. And that's how, these initiatives being taken results in maintaining the EBITDA margin that we really want to grow over a period of time. I hope I am able to answer your question.
Yeah, sure. Thanks. The second one is on capital allocation. I think there was a comment earlier in the day from Srikanth around potential M&A opportunities. So some more color around, some more details around which are the potential areas you're looking at. I think account aggregator was one space that you had previously mentioned as well. But that space, anyways, I don't know in terms of pricing rationality if you have any strong views there, and in terms of generally how it adds to your overall revenue diversification efforts as against let's say paying out higher dividends.
Sure, Abhijit. This is Srikanth. Let me take that question for you. See, we first of all, as an organization, we want to be focused largely on asset management space, first and foremost. Yeah. And hence, dabbling into other businesses which may seem, incidental and ancillary to this business, but we believe that we would want to play to our strengths, which is to kind of drive more and more depth as well as breadth into the asset management space. So within this space, already every asset class is important for us, and expanding geographically for the same asset classes is the second most important thing. Third thing is expanding the scope of services across the same asset classes, across multiple geographies is the most important thing for us. So basically, if you were to put an XYZ axis, those are broadly, right? Every asset class, as many countries as possible, every scope of service that is possible to be rendered, for X and Y axis is, truly what we are very keen to do. In terms of capital allocation, our M&A strategy, had been and will continue to be so. For example, when we acquired Hexagram, that was to add a layer of a service which we hitherto never used to do, which is the fund accounting administration side of things. So we're looking at scope of services, on the issuer solutions, for example, where there are more domain-centric services. For example, are there things that we can do to provide cradle to give solutions like, ESOP administration, for example, or investor relations side of things. Or if you look at alternate investment funds, both the TA and FA aside, the entire administration layer, especially if you were to move to GIFT City and so on and so forth. So I do not believe that we are intentful at the moment to look at insurance and others, not our forte. We want to be a more focused asset management space. Account aggregation, yes, we continue to be interested. That's more from the standpoint of value addition we can render to the entire wealth management and asset management space, and not just by virtue of an AA itself. We believe it will be a reasonably commoditized business over a period of time, excepting, of course, the value-added component as a TSP that you can render to the asset management space.
So, Abhijit, just to add to what Srikanth mentioned on your question on capital allocation to dividend policy, we believe that if we can create future modes through acquisition rather than paying out is always a preferred mode. However, board reserves the right, along with the shareholders, to decide, what is the balancing act the board wants to play on the dividend payout. But it's always our preference to create value for shareholders through constant evaluation of available M&A opportunities in the market, and that's what Srikanth alluded to, that we continue to evaluate, but in those areas where we feel that we need to get into.
Got it. Thanks a lot.
Thank you. We have the next question from the line of Sarang Sanil from RW Investment Advisors. Please go ahead.
Good evening, sir. Am I audible?
Yes, you are.
Yeah. Thank you for the opportunity. Sir, could you please provide the absolute number for legal and professional expenses? So the reason I'm asking is that over a period of time, this is one of the components that dragged our margin. So would it be possible for 9 months or Q3 of FY23?
Legal and professional fees.
Yeah.
So for the quarter, that specific number will come back to you, Sarang.
Sure. Also, would it be reducing as a percentage of revenue going forward?
Yeah. So I'll tell you, there is an increase of about 11.4 crores in the legal and professional expenses year on year for the 9 months period ended. It's obvious, as I mentioned, that we have taken certain actions where we are reducing dependency on external help, and therefore this number is likely to come down quarter on quarter.
Sure. Okay, sir. So also, regarding the 3 litigations against the company that's mentioned, the DRHP, any recent update on that? And also, what is the material amount relating to these litigations that could impact our business?
I don't know which litigation specifically, if you can mention which litigation.
All right, sir. So there are 3 against the company. Those are related to IPO issue, Yes Bank, IDFC, and...
Okay. So there is nothing that, we have filed discharge application in all the cases. We don't expect any liability on the company or its existing directors. It is something which is related to past, where the corporate wheel is lifted and the people who were in charge at that point of time are held liable. Whatever may happen in terms of the court, taking its own decision, there is nothing we expect as a result of that happening on the company. As far as the status is concerned, there is no change in status. There is, a new date which we get. So far, I have seen that in the last 3 years, there is no decision or hearing which has happened, except that we filed discharge application that is yet to be, argued and decided upon.
Sure, sir. So my final question, any reason as to why the margins of data processing business segments have been volatile over the period?
Sorry, margins of data processing.
Yes, data.
See, Sarang, I think that is something that we reported as part of the financials and all, right? The data processing piece, it includes all the different, the line of businesses which gets clubbed into the data processing. But if you look at, the mutual fund issuer solutions, across all these businesses, we are kind of, similar gross margins is something that we, run with, between in the range of around, let's say, 40 to 45%.
Sure. Thank you, sir. Thank you so much, and all the best.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Abhijit Sakhare for closing comments. Over to you, sir.
Thank you all for joining the call today. Goodbye.
Thank you.
Thank you. On behalf of Kotak Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.